Hello, my online viewers. This is CP Edwin Choi. So for today, I want to check on some of the papers you did last sitting. That is the sitting which just ended, the August sitting. So I'm going to check a paper of advanced financial reporting that is under CS 63. Most important, I will do the first question in that sitting that is concerning earnings per share. At the same time, I will check and do the group accounting question. And again, I can be able to do the share-based payment transaction question. So, but for today, let us start with the EPS question, that is earnings per share, which was requiring the student to do the basic earnings per share and diluted earnings per share. So earnings per share question was question number 2 in that advanced financial reporting paper, whereby the examiner said that he gave you the capital structure of share remittent. He said that the following capital structure relates to share remittent as at 31st December 2020. So he gave you the ordinary shares of shillings 10 each, 10% cumulative preference shares of shillings 20 each, 12% convertible loan notes of shillings 10 each, profit after tax for the year. So you were given an additional information whereby he said on 1st February 2020, the company issued 1.5 million ordinary shares at full market price. On 30 June 2020, the company made a right issue of 1 ordinary share for every 4 ordinary shares held on that date. The exercise price was shillings 36 per share, and the market price on the last quotation was shillings 48 per share. So the convertible loan notes were issued in the year 2018. 10 convertible loan stocks are convertible into 1 new ordinary shares. Number 4, on 1st October 2020, the employees of the company were granted share options to purchase 1 million ordinary shares of shillings 30 each. The average market price was 48 per share. As at 31st December 2020, none of the employees had exercised their options. So the corporation tax rate is 30%. So you are required to do the basic earnings per share for the year ended 31st December 2020 in conformity with the International Accounting Standards 33, 6 marks. And you are required to do the diluted earnings per share. That is the diluted earnings per share. So when you are doing basic earnings per share, what you need to know is that basic earnings per share is all about the profit attributable to ordinary shareholders. So the first requirement was we do the basic earnings per share. Basic earnings per share. So whereby I say that it's all about the powers of our nose. So powers means that the profit attributable to ordinary shareholders, and the one is the weighted average number of ordinary shares. So how are you supposed to get your powers? That is the profit attributable to ordinary shareholders. So you start from the reported profit after tax. So you are supposed to start from the reported profit after tax. So the reported profit after tax. You are supposed to subtract profit attributable to NCI. NCI is all about minority shareholders. So the profit attributable to minority shareholders. So profit attributable. So the profit attributable to NCI, that is minority shareholders. Then again, you are supposed to subtract the preference dividends. The preference dividends. So that is the preference dividend. So that is the format which you are supposed to use in order to arrive at the profit attributable to ordinary shareholders. So let us check the relevant figures to apply in the relevant formula. Let us check the relevant figures So right now, I said the first thing is all about the profit after tax for the year. So you can see we are given the profit after tax there. So which is 171,200. So that is 171,200. So that is the profit after tax. So was there the profit attributable to NCI, which is the non-controlling interest? Again, let us check. So going through the question, I cannot be able to see anything concerning that. I cannot see anything concerning the profit attributable to non-controlling interest. There's nothing like that. So which means that this one will be just a dash. Then after that, we have to check if there was a preference shares which were issued or outstanding from the initial period. So we have some preference shares which were there from the start of the year. So because they say that the foreign capital structure rates to share remitted as at 31st December 2020. So which means that these are about the relevant capital structure for that period. So the preference shares which were there, we were given 10% cumulative preference shares of shillings 20 each at a total of 40,000. So which means that this entity was paying a preference dividends on a contractual rate of 10%. So you take 10%, you multiply with the 40,000. So that is how I would be able to arrive at the preference dividends. So 10% of 40,000. So that is 4,000. That is 4,000. So I can be able to use my calculator so that to get the difference. So if I take 171,200, you minus the 4,000, I'm getting 167,200. I'm getting the 167,200, and that is the profit attributable to ordinary shareholders. So the next thing we have to compute is now the one-offs. I have to compute the one-offs. The one-offs, that is a weighted average number of ordinary shares. So the one-offs. So I have to check the one-offs. So in order to get the one-offs, remember that this is all about the ordinary shares, which are weighted as per the time factor. That is from the time they were existing or from the time they were issued. Right now, we can look at the question. We have various ordinary shares which were issued for that period. And we have some which were outstanding as per the capital structure which is provided. So, but now with more emphasis, in any question you are doing for the EPS, you have to put in mind if there is these scenarios. So which are these scenarios? If there is an aspect of right issue, if there is an aspect of bonus issue, if there is an aspect of share split, and if there is an aspect of reverse split. So according to our question, there was a right issue. So if you can check other questions I've did for other previous videos, you can be able to determine some of the questions whereby we were having maybe share split, reverse split, bonus issue. So that one has already been dealt with. But now, with more emphasis of this question now for the August sitting, they tested your question whereby they provided a right issue in note 2, in addition information number 2. The examiner said that on 30th June 2020, the company made a right issue of 1 ordinary share for every 4 ordinary shares held on that date. So the exercise price was 36, and the market price on the last quotation was shillings 48 per share. So remember that a right issue is whereby the entity decides to give the existing shareholders shares at a lower price than the existing market price based on a certain proportion. Like now in this scenario, the proportion was 1 ordinary shares for every 4 held. At what price? At an exercise price of 36. Remember their market price was 48. That is the direct interpretation of what a right issue means as per the additional information number 2. So when there's an aspect of right issue and you are going to do your nose, you are going to determine the weighted average number of ordinary shares. Obviously, you have to use a certain formula. And which is this formula? This is the relevant formula you are supposed to use. So we always say that ordinary shares before right issue, ordinary shares before right issue, before the right issue, ordinary shares before the right issue, we multiply with the theoretical ex-right price, we multiply with the fair value before right issue, sorry for that, fair value before right issue, fair value before right issue. We always divide with the theoretical ex-right price, theoretical ex-right price. We multiply with the period before right issue, period before right issue, period before right issue. Then what I'm getting from these first brackets enclosed, I will be able to add with ordinary shares after right issue, ordinary shares after right issue. So the ordinary shares after right issue, we multiply with the period after right issue, with a period after the right issue. So period after the right issue. So in order now to know which are some of these relevant shares you are supposed to apply in the formula, we have to do the relevant analysis. We have to do a short analysis of the shares which were issued or outstanding from the initial period. So we have to do the analysis of shares. So let me do the analysis of shares. Analysis of shares. So here I have the date when they were issued, or from the period which they were outstanding. So that is the date. We have the details, and we have the relevant shares. So we need to determine this. So our financial year starts when? Our financial year starts on January. Our financial year was ending on December, which means that it was starting on 1st January. So as of January, which are the relevant shares? Which are the relevant shares we are supposed to record? Obviously, the shares which were outstanding as per the given capital structure. As per the given capital structure, they are saying that ordinary shares of shillings 10 each, so the total is 60,000. So 60,000 is the value. So to get the number of shares which they issued in order to raise a capital of 60,000, so we take 60,000, we divide by 10. We take 60,000 divided by 10. So that is 1st January 2020. So that is all about balance brought down. So the balance brought down on that period is all about 6,000. So because 60,000 divided by 10. Then the next thing is all about, the next thing is concerning if we check if there's another ordinary shares there. So that is the one which was there as per the given capital structure at the start of the period. So we move to additional information. Additional information number 1, they are saying on 1st February 2020, the company issued 1.5 ordinary shares. So these are the number of ordinary shares. That is good. At a full market price. Full market price is that initial price of 10 as per the given capital structure. So which means that on 1st February, the number of shares which were issued is just 1,500. The one which is given direct. So those are the one which we weigh. But now in this scenario, remember that I'm not supposed to weigh direct because there is this aspect of the formula which we are supposed to use. So for now, I'm looking for the only shares. So I don't have to weigh at this stage. Because now to determine the weighted average number of ordinary shares, in the case of right issue, we have to use the formula. So what I would just write here is just those number of shares which were issued on 1st February 2020. I say here, new issue. I say new issue, I record 1,500. I have to check again if there is another thing which was issued. To be more specific, if there was another ordinary shares which were issued in the period. Additional information number 2, remember that when they made a right issue, it's only that they issued ordinary shares to the existing shareholders at shillings 36 instead of 48, which was a market price. So we need to know how many shares were issued through the right issue. Remember, the proportion was 1-for-4 ordinary shares held as at that date, which is 30th June 2020. So the company made a right issue of 1 ordinary shares for every 4 held. So I have to say 30th June 2020. 30th June 2020. So the right issue. So the right issue there, right issue, it was 1-for-4, which 1-for-4. How many shares are held by this time? This total here. So the 7,500. So if I take my calculator, I say 7,500 divided by 4. So I get 1875. I get 1875. So 1,875. Those are the number of shares with the entity issued through a right issue. Now the 3 was concerning convertible loan notes. That one is never used in. That one is never used in basic earnings per share because they are supposed to be used in diluted. Diluted earnings, when we are going to do diluted earnings per share, is when I will be using securities which are likely or unlikely to be converted to ordinary shares. So the securities which bear the word convertible, including share options and warrants. So when I will be doing my diluted earnings per share, I will use convertible securities, the one which are going to be converted to ordinary shares, or we anticipate that they will be converted. So that is why I say they are likely or unlikely to be converted to ordinary shares. Like now this one, the convertible loan stocks were issued in the year 2018. 10 convertible loan notes are convertible into one new ordinary shares, into one new ordinary shares. That is fine. The number 4, they say that on 1st October 2020, the employees of the company were granted share options to purchase 1 million ordinary shares. So obviously, I've said again, share options are used in computing diluted earnings per share. Share options are used in the computation of diluted earnings per share. Beside the convertible securities, like now convertible loan notes, bonds, or convertible preference shares. So for now, we are done with the determination of the relevant ordinary shares, which can be applied in the formula of determining weighted average number of ordinary shares when there's this aspect of a right issue. So we can be able to apply these shares in our formula. So ordinary shares before right issue. So one was here, we say ordinary shares before right issue. So ordinary shares before right issue is this total of 7,500. We multiply with, so the fair value before right issue. Remember that the fair value was 48. For the theoretical strike price, this one, I have to do a working. I have to do a working here. So in order to determine theoretical strike price. So for the theoretical strike price, we always say that the proportion was 1 new for every 4 which were held. So 4 old. So the 1 new is at a price of the exercise price, which was 36 as per note 2. Then 4 old is at the market price which has been existing of 48. That is from note 2. So we multiply the 2, 36. So 1 times 36, that is 36. Then 4 times 48, that is 192. That is 192. So here we say the total 1 plus 4, 5. 192 plus 36, that is 228. So we divide the two. 228 divided by 5. So 228 divided by 5. So that is 45.6. So 45.6. So this is 45.6. Then multiply with the period before right issue. So the period before right issue, the right issue occurred on 30th June. So which means that the period before is from January to the 30th June. So which means that is 6 months. So 6/12. Then we add with ordinary shares after right issue. So ordinary shares after right issue is all about the shares which were there before, which is 7,500. The one which was before is 7,500 plus the one which were through the right issue. The shares which they issued through the right issue, that is 1875. So I'm getting 93.75. I'm getting 93.75. Then we multiply with the period after right issue. So period after right issue is from now 1st July to the end of the year, because the period before was from January to 30th June. So the period after is from 1st July to 31st December. So I can be able to use my calculator to get the one-offs. We can be able to input directly the way we have written. So times 48, you divide with 45.6. We multiply with 6/12. We add 93.75 times 6/12. So I'm getting that is 86.35. 86.35. So I can be able to say that basic earnings per share here. So basic earnings per share is equals to the profit attributable to ordinary shareholders, which is 167,200. So we have 167,200. You divide with 86.35. So if I do that, what am I getting here? So 167,200 divided by the answer. So I'm getting 19.36. So I would say shillings 19.36 per share. So that is 19.36 per share. So let us do diluted earnings per share, because we are done with the first requirement. The first requirement was concerning basic earnings per share. The basic earnings per share. So you have your 6 marks. So the next thing is all about diluted earnings per share. So for the diluted earnings per share, remember that I said we always use potential securities. So potential securities, these are the securities which are likely or unlikely to be converted to ordinary shares. So the first step we always do is all about to determine basic earnings per share, of which we have done that as per the first requirement. The step number 2 is now to determine the order of ranking the securities. Then after that, we have to compute the diluted earnings per share based on the ranks, which we have done in step number 2. Then from there, we can be able to choose which is our diluted earnings per share. So I have to start from step number 2, because step number 1, we are already done with it, because it was part of the requirement, which was a determination of the basic earnings per share. So step number 2 now, let's determine, and that is the point whereby I have to start from when doing my diluted earnings per share. So let us determine the order of ranking the securities. Determine the order of ranking. Determine the order of ranking the securities. determine the order of ranking the securities. So remember that I said we are supposed to use potential securities, the potential securities. So we use potential securities. So the securities which are likely or unlikely to be converted to ordinary shares. So our first column will be concerning incremental earnings. I will explain why we have incremental earnings. We have the incremental earnings. Then after that, we have incremental shares. Also, I will explain why we have this. Then we have two remaining columns here. The one for ranking, the one you rank, the last one. Then here is all about earnings per incremental shares. Earnings per incremental shares. Earnings per incremental. Earnings per incremental shares. So that is the case. So I'm going to explain where we have incremental earnings column and incremental shares. So let's say, for example, you are dealing with the loan notes, convertible loan notes. So these convertible loan notes, the entity is supposed to pay interest on that. So if the relevant security which attracts interest is converted to ordinary shares, remember that they will not pay this interest. The interest will not be paid in short. So that is why, in short, you would have an incremental earnings because the interest was never paid out of that security. Then we have the aspect of incremental shares. So since that security now concerning, for example, the convertible loan stock has been converted to ordinary shares, remember that obvious again, the ordinary shares will increase. So interest was never paid, earnings, there was some savings which they did. That is why earnings, we have the column of incremental earnings. They converted to, the security was converted to ordinary shares. So that is why we have the aspect of incremental shares column. So in this question of ours, we were having some convertible securities, some potential securities. That is the good name I can use. So which are these potential securities? There were just two. So we have the convertible loan notes and we have the share options. That is according to the additional information number 4 and additional information number 3. So those are the only potential securities which I have. So I will start from a convertible loan notes. So the convertible loan notes. So I will start from convertible loan notes. So for the convertible loan notes, I will start with earnings. I will start with the earnings. So the relevant figure for the convertible loan notes, the relevant figure is given, or the relevant amount for the security. That is according to the start of the question. So the 12% loan note of shillings 10 each at 50,000. So it was a 12% convertible loan note. So 12% convertible loan note. So under earnings, remember that they were supposed to pay interest at 12%. You multiply with the value of the security, which they never paid, which means that they made a saving. That is why we have the earning increasing. And since the relevant payment they were supposed to do is concerning interest and they never paid. And remember that interest is an allowable expense. It has to attract a tax shield. And we say tax shield is 1 minus T. So that is why you can see in the additional information number last, you were given tax. T is concerning tax. So you say 1 minus 0.3. So that is 0.7. So under this security, I have to multiply my earnings with 0.7. So, and this one is only multiplied whereby the return from the securities interest, not dividends. So dividends is not an allowable expense. So since this is an allowable expense, interest is an allowable expense. They never paid that, so that is why this is a saving. So then we have incremental shares. So under shares, remember that under incremental shares, we have to use the proportion. And the proportion was given in that addition information number 3. So the proportion was 10 convertible loan notes are convertible into 1 new ordinary shares. So that is 2 convertible into 2 ordinary, into 2 ordinary, into 2 ordinary. So even if you can equate, so 10 into 2 ordinary. So the total value was 50,000. But remember, this one is concerning the proportion is in terms of shares. So which means that the number of relevant shares. So if you can check the security so that I can be able to confirm. So yes, then the value I would equate with, the value I would equate with is 5,000, not 50,000, because the proportion is in terms of shares. So that is 10 convertible loan notes are convertible into 1 new ordinary shares. So they never say, if they could have said, for example, shillings 10 convertible loan notes, is when I could have used the total value of 50,000. But here they say just 10 convertible loan notes. They never said shillings 10 convertible loan notes. So that is why I'm reducing the 50,000 to 5,000. So which means that this one will be 5,000 times 2 over 10. So if I use my calculator to get this, so the first one was concerning 0.12 times 50,000 times 0.7. So that is 4,200. And the next one is all about, that is 1,000. So if we divide the two, 4,200 divided by 1,000, so that is 4.2. This one goes with this. So it will meant to be 4.2. Then the next one is all about the options. So the options, obviously the earnings will be 0. Earnings will be 0 because nobody will exercise to that option. Nobody will exercise to the option. That is what they said. That is not my words. They said none of the employees had exercised their options. That is according to note 4. There are sentences there. But now, what about what if they converted? What if they exercised? That is, what if they exercised? So let's check on the shares. So this is what could have happened. So remember that if they could have exercised, remember that they were given which option? They were given which option? They were told that to exercise on 1st October, the employees of the company were granted share options to purchase 1 million ordinary shares at 30 each. The average market price was 48. The average market price was 48. So we will take 1 million, the 1 million, which is 1,000. I have to multiply with what they could have benefited with. Since the average market price was 48, I will take 48 minus the exercise price. You divide with the market price. Because they were told to exercise at 30 and the average market price was 48. So it's like now saying 18. You divide the total market price times the option which they were given. Then you weigh. Those number of shares they could have exercised. So from October, when they were given an option. So from October to the end of the year, those are 3 months. October, November, December. So those are 3 months. So that is 18 you divide with 18 you divide with 48 times 1,000. So then you divide with 4 because 3 over 12 is like a quarter. So I'm getting 93.75. 93.75. So if I divide the 2, I'm getting 0. So then I will have to rank from the list. So this is number 1 and this is number 2. That is number 1 and that is number 2. So we are done with step 2. So step 1 was all about the part of the requirement, computing basic earnings per share. Step 2, we have determined the order of ranking the securities, which I said obviously we use potential securities when you are doing your diluted earnings per share. We have done that. We have used our potential securities. That is the convertible loan notes and the options. So we have determined the ranking, whereby we have ranked options are the first one. We always rank from you rank the securities from the risk. When I say the risk, I mean the security which has a risk effect to the diluted, to the basic earnings per share. So the security which has a risk effect to the basic earnings per share. So that is why I did a convertible first, which is okay. I did options, which is fine. I determined earnings per incremental shares. After that, then I ranked from the risk security, the one which has a risk effect to the basic earnings per share. You have to get some basics. Like now when determining convertible loan notes under earnings, you can see what we did. Remember I talked about something concerning interest and something concerning tax shield. I said that when the relevant return which was supposed to be paid in the securities in interest, remember that they never paid these because the security is being converted. So after we determined that interest which was supposed to be paid, then since it was an interest which is an allowable expense, that is why it attracted a tax shield, which is all about a tax saving which was done, because this is an allowable expense. And that is only applicable there when the relevant return which was supposed to be paid is interest. But that one is not applicable when they were supposed to pay dividends, because in some questions you might find we have convertible preference shares. So for the preference shares, whereby they are supposed to pay dividends, you are not supposed to apply the tax shield. For incremental shares, it's all about using the options, not the options, but the proportion. Or now they did the conversion. Then for options, remember that obvious for the earnings, no employee would exercise. That is why the earnings is 0. Then now you check for the shares, what if they exercised? So you weigh the shares, the relevant shares you determine out of that. So that's why we took 1,000, you multiply with 18 over the total 48, you weigh by multiplying from the period in which the option was granted. So step 3 is all about now you compute diluted earnings per share. So compute diluted earnings per share. So compute diluted earnings per share, DPS, diluted earnings per share, based on the ranks in step 2 above. So that is why here I have the earnings. I will talk about earnings. I will talk about shares. Then I will talk about DPS. So we start from basic EPS. So from basic EPS, our basic EPS. So the earnings is all about the pause. The earnings is the pause, which we determined as 167,200. 167,200, this one. Then for the shares, it's all about the one-offs, which was 86.35, which was 86.35. Then we went ahead to determine 19.36, which is the basic earnings per share. That is why I always say that first step under diluted, determine basic earnings per share. That is what I have started with. Then from there now, I have to check the securities, the potential securities which has a risk effect to the basic earnings per share. That is why I ranked the option as number 1, because it has a risk effect to the basic earnings per share. After we did this one, we got 0. So 0 is risk than 4.2. So which means that this is options. So for the earnings, here is 0, this one. Then for the shares is 93.75. So this is 167,200. Then the other one 86, 86, 86, 35. That is 86, 35. 86, 35 plus 93.75. So I'm getting the total there is 87.28. So that is 87.28.75. So if I divide 167,200, divide the answer. So that is 19.16. 19.1. 16 or what? Yes, 19.16. 19.16. Because it's 167,200 divided by, so I got 167,200 divide 87.28.75. Yes, that is fine. So then the next thing is all about the second security, number 2. So we have, it was convertible loan notes. So loan notes, so 4,200, and this is 1,000. So this one and that one. So if I take 167,200, 167,200 plus 4,200, I'm getting 171,400. Then this one would be 97.28.75. So I divide the two. So what is 171,400? You divide with 97.28.75. So that is 17. So that is 17. So 17.62. So that is 17.62. So 17.62. So that is fine. So I would be able to say that diluted earnings per share is equals to shillings. So you pick now the risk among the 3. So that is 17. So shillings 17.62 per share. So that is 17.62 per share. And that is the case. That is the case. So this is what was supposed to be done in the last sitting concerning this question number 2 for the earnings per share. That is according to International Accounting Standards 33. So this paper was a bit easy because even the other questions I can see right now, there was a question of segmental reporting. We have a question of deferred tax. We have a question of share-based payment transaction. So these all were easy questions. So for today, I have started with a question of earnings per share. Our next session, I will be able to do that question of a share-based payment transaction on the coming video. So what I would advise you to do is all about start preparing for the coming exam. That is for the new syllabus, which is coming on the end of November, the advanced financial reporting. So if you would like to attend my online classes, I'm doing Zoom classes at an affordable fees. You can be able to reach me. You can be able to call me so that I would be able to add you to my WhatsApp group, and we agree on how we do those online classes. So my contact is 0728 760 546. So that is my relevant contact. So the Zoom classes are ongoing for the preparation of the students who are going to sit for the November exams for the new syllabus. So let's meet on our next session when I will be doing that question of share-based payment transaction. So for now, once you have watched and gained from this video, never forget to share with your friends while doing the same. Remember, this one can be applicable in various areas other than in CPA. Maybe in your undergraduate, they do the same. Like now in financial statement analysis, they do the same. That is in CIFA, that is a Certified Investment Financial Analyst. The same thing is applicable in your undergraduate, in other field other than even in CPA only. And again, I welcome you to join the online classes. Just reach me through that contact so that we can be able to discuss more. Never forget to subscribe so that we can be able to grow this channel for this just a free content which is offered. So have a good time and have a good enjoyment of the same session. Thank you.